All right, welcome back. Hope you all enjoyed your break. Uh, let's talk about the accounting cycle. We've been doing the accounting cycle this entire time, and I'm sure some of you probably caught on. We're gonna put it all together for you. As I had mentioned earlier, everything that we do kind of builds off of what we've already learned in this course. Yeah. Uh, we started out easy with the accounting equation, and we talked about the income statement, balance sheet, statement of cash flows. We talked about journal entries, adjusting journal entries. We talked about depreciation. We talked about those kinds of concepts. Now I want to show you what it looks like. What's the big picture? Yeah, it's like what are we doing this for? Uh, I want you to understand that uh, there's a process. It's called the accounting cycle. And we follow this process every single year. Every single year, we follow this process in business. And, it's called closing out the books. We close out the books every year, we start fresh. Uh, and we do that for a lot of reasons, taxes and, any adjustments, etc. And so we go through this accounting cycle every single year. And I want to show you why. Why do we do it? One step in the process that you might use, don't have to use, but you might use, is called a worksheet. This worksheet helps us to identify any errors that we may have made throughout our closing entries and our adjusting entries. Helps us to identify any errors. Uh, Personally, I do not use this. I have not used a worksheet in a very long time in the accounting process. The reason for it is we use a lot of accounting systems. QuickBooks, Sage 50, NetSuite by Oracle. These are all accounting systems. Yeah. FreshBooks. There's like a million of them out there. If you use an accounting system, not just Excel, but if you use like an actual accounting system, a software, it reduces the risk. And that's why I personally don't use the worksheet, but you could. You could. There's 5 steps to using a worksheet if this is what you want to do. And it's similar to the adjusted trial balance that I showed you from the last chapter. First, we do the unadjusted trial balances, and then we do the adjusting entries. We prepare the adjusted trial balance, and then we try to match those adjusted trial balances to the financial statements, and then we match those to the income statement and balance sheet columns. This is what it looks like. Really, it's just an extrapolated version of the trial balance. And the trial balance, we got unadjusted trial balance, adjusting entries, adjusted trial balance, and then we have tying it to income statement, balance sheet, statement of cash, and statement of owner's equity. And it's really designed to be a method for you to be able to make sure that you didn't make any errors along the way. And that's really the purpose of the using a worksheet in the accounting cycle process. Again, not required, but it's something that some companies do. I personally do not because I have software that does this. I could if I wanted to, but I usually don't. At the end of every single year, we go through a process, or I'm sorry, at the end of every accounting period. So at the end of every month, technically, We go through a process called closing out the temporary accounts. Now let me explain this part. You start every single month with zero sales, zero revenue, and zero expenses on your income statement. On your income statement, you have revenue, cost of goods sold, all of your expenses, and then you have net income. Your revenue and your expenses on the income statement, we call those temporary accounts. And at the end of each month, we close those temporary accounts out to the statement of retained earnings, or statement of owner's equity, whatever you want to call it. And the reason why we do that is because you need to start every month fresh. You don't start with sales at the beginning of the month before the month starts. You don't start with expenses the very first day of the month. They start at zero. And so we close out everything at the end of every month. So that way we can start every month with zero on our income statement. There are two types of accounts. There are temporary accounts and permanent accounts. Permanent accounts are accounts that always have a balance. These are your assets, liabilities, and paid-in capital. On your balance sheet, your assets, your liabilities, and your paid-in capital accounts will always have a balance in them. Yep, always have a balance. Therefore, they are permanent accounts. Temporary accounts are accounts that we close out at the end of each accounting period. These would be your revenue, your expenses, your owner's withdrawals. And we close these out through a process to our what we call an income summary that will end up on our statement of owner's equity. And the reason why we close out these temporary accounts is because we need to start every accounting period, every month, with no revenue and no expenses on our income statement. Because the income statement needs to be representative of the revenue and the expenses earned during the accounting period, according to, again, the matching principle. So there's a process to do this. First, we identify the accounts we need to close out. These are our revenue accounts, expense accounts, owner's withdrawal accounts. We need to get those down to zero. So the way we do that is first we identify which those accounts are. And the second step of the process is we prepare and summarize what's called an income summary account. This is an account that helps us to close out our revenue and expenses during the accounting period. And then the third step is that we will prepare a post-closing trial balance. Sets us back to zero, yes? So the way it works is for my revenue accounts, the way I close my revenue accounts is I debit revenue. I debit total revenue and I credit income summary. What that does is it moves the revenue out of revenue and into income summary. debit revenue account, credit income summary. Moving it out of revenue and into income summary. Income summary is like the account that's how we move it to owner's equity, yeah? And then I need to do the same process for my expense accounts. I debit income summary and I credit my expense accounts. What that does is it takes the expense balances and moves it into income summary. And then the third step is I take the total income summary and I move that into owner's equity or owner's capital. And I also close out my owner's withdrawals to owner's capital. That's the process for closing out the temporary accounts. Here we see the process in action. First, we close out the credit balances, and then we close out the debit balances, and then we close out to the income summary account. Then we close the owner's withdrawals. We see how it flows. We're taking out our revenue, we're taking out our expenses, we're putting it into income summary. And then the income summary, we're putting it into the owner's capital. Minus withdrawals gives us the balance for owner's capital. And what that does is it closes out our temporary accounts. So that way we can start the next month fresh. And we do that every month. It's a very simple process, I promise. It's a lot simpler using an accounting system like QuickBooks or Oracle or whatever. But it's important that we understand how and why we do this. At the end, just to make sure that everything worked out properly, we list out all of our permanent accounts. We list out we list them out to make sure that our debits equal our credits. We do that through what's called a post-closing trial balance. Our accounts that normally have a debit balance are our asset accounts. Accounts that normally have a credit balance are our liability accounts and our equity accounts. Assets equals liabilities plus equity. This is what's represented here in the accounting equation. Assets normally hold a debit balance. Liability and equity accounts normally hold a credit balance. Debits must equal credits. And that's why we perform the post-closing trial balance to ensure that our assets equals liabilities plus equity. And if it doesn't, that means there's a problem somewhere, and we have to find it. So the accounting cycle, and we've been talking about this for the past 2 weeks. We've been doing it for the past 2 weeks, but you just maybe you haven't recognized it. So there's 10 steps to the accounting cycle. First, we analyze the transactions. We learned this back in chapter 1, I believe. In chapter 1, we talked about assets equals liabilities plus equity. We talked about the different asset accounts and liability accounts and equity accounts. And then we talked about how the transactions affect the accounting equation. That's called analyzing transactions. We did that back in chapter 1. In chapter 2, thereabouts, 1 and 2, we learned how to journalize. We learned how to prepare journal entries by debiting accounts and crediting accounts and ensuring that our debits equal our credits. We might debit an asset account and credit a liability account, or something along those lines, right? That's called making journal entries. That's step 2. And then in step 3, we posted those journal entries that we made from step 2 into what's called the General Journal Ledger. General Journal Ledger, also known as General Ledger. And what that did is it provided us with balances for all of our accounts. And now once we knew those balances, now we're moving into the last chapter, chapter 3. Once we know those balances, then we can prepare the unadjusted trial balance. The unadjusted trial balance is a list of all of our accounts with their respective balances. And then I made my adjusting entries, chapter 3, and posted those to the general journal, as we see in step 5 here, adjusting entries and posting to the accounts. Then I got my balances. Once I have my new balances, I can prepare the adjusted trial balance, which is the unadjusted trial balance plus or minus the adjusting entries equals the adjusted trial balance. Those adjusted trial balances help me to then prepare the financial statements, the final income statement, balance sheet, statement of cash flows for the year, or for the accounting period. Could be for the month, who knows? And once I had my financial statements prepared, now I'm moving into chapter 4, this chapter, I can then close out my temporary accounts to the permanent accounts in order to start fresh for the next accounting period. And I do that by debiting the revenue and crediting the income summary to close out my revenue accounts, and by debiting income summary and crediting all of my expense accounts to close out the expense accounts. And then once I've done that, moving on to step 9, I can prepare the post-closing trial balance. And what this does is it helps me to recognize that my total debits equal my total credits. And I do that by listing out all of my asset, liability, and equity accounts. And remembering that all asset accounts normally hold a debit balance, and all credit accounts normally hold a credit balance. And then once that's done, I can do any reversing entries that I need to make, which are corrections, and post those if I need to. And then I do the whole thing over and over and over again every single month. Isn't that fun? But in all seriousness, the software that is available will certainly take care of all of this for you. So it looks like a lot of work. It does. It looks like a ton of work. You're like, man, I no longer want to be an accountant because this is going to drive me nuts. But I promise you, the software handles all this stuff for you. All you need to do is make sure that your journal entries, when they go in, are correct. And you can generate all the reports that you need. Yeah, that makes what makes it easy is the software. We've made a lot of advances over the years. Now, for reporting, we oftentimes create what's called a classified balance sheet. Now, you've heard me say throughout the past 2 weeks that there are different categories, right, of assets, of liabilities, and equity. We have current assets, and we have fixed assets. We also have non-current assets. which are also known as fixed assets to a degree. These are also called long-lived assets. And then for liabilities and equity, we have current liabilities, long-term liabilities, and equity. For assets, when an asset is called current or short-term, it means that I expect to utilize those assets within 12 months or less. That's what current means, 12 months or less. For current assets, this would include things like cash, accounts receivable, inventory. Those are my current assets because I expect to utilize those assets within 12 months or less. Non-current assets, these are the long-term stuff. This would be stuff like property, plant, and equipment, right? Long-term, yes, expect that. Hold on to the property, plant, and equipment for a long time. And then sometimes I might have intangible assets like a copyright or something along those lines, yeah. Or goodwill. Those are intangible assets. And I also have other long-term investments like I purchased a piece of land, don't plan to do anything with it. It's a long-term investment. For liabilities, we have current liabilities and long-term liabilities. Current liabilities are liabilities that I expect to pay within 12 months or less. This would include things like accounts payable, wages payable, taxes payable. I could keep going on, a lot of payables. Those are my current liabilities. I owe them within 12 months or less. My long-term liabilities would include things like a car loan, a mortgage. These are long-term liabilities. Student loan, long-term liabilities, yes. Then, of course, we have equity. Equity is what the owners own. So that would include things like paid-in capital, etc. So on our classified balance sheet, it might be broken out this way. It usually is. Current assets go first and then long-term assets. Okay. And then on the liability side, we have current liabilities first, then long-term liabilities. And then, of course, we have equity. The way that it's organized is important. And the reason for that is it's organized in terms of what we call liquidity. Liquidity simply means how quickly I can turn something into cash. That's what liquidity means. Liquidity, how quickly I can turn something into cash. Liquidity. The assets are organized in terms of liquidity. That's why cash is always first. Then we have short-term investments, accounts receivable, inventory, prepaid expenses. I can quickly convert all those things into cash. And then I have things that I cannot quickly convert into cash, which are long-term assets. Notes receivable, investments in stocks and bonds, land held for future expansion, property, plant, and equipment, etc., etc., etc. Those are all long-term assets, yeah. And you see, it's organized by liquidity. Right. The ones at the top quickly convert to cash. Toward the bottom, not as easy. Takes a lot longer, yeah. Under liabilities, it's current liabilities and then long-term. Current liabilities are accounts payable, wages payable, notes payable within 1 year or less, the current portion of long-term debt. Those are all current liabilities. And then long-term liabilities would include things like a mortgage, a car loan, student loan, etc. And then equity. Of course, equity is what the owners own. That's their capital. Paid-in capital, there's a couple of other examples. And then if the company is publicly traded and they issue shares of stocks or bonds, that would also be included under equity. So to classify, again, current assets we expect to utilize within 1 year or less. Cash, accounts receivable, inventory, those are all current assets. Use it within 12 months or less. Long-term investments. We expect to hang on to this stuff for more than 1 year. It would include things like property, plant, and equipment, investments held for sale, etc. Those are long-term investments. Property, plant, and equipment, plant assets. Intangible assets. This would include things like copyright, a patent, etc. Things that we cannot physically touch, but we own them. That's what makes it intangible. For liabilities, we got current liabilities. These are payments due within 1 year or less. Examples would be accounts payable, wages payable, taxes payable, current portion of long-term debt. This is 12 months or less. Long-term liabilities are liabilities that will last longer than 1 year. Examples of this would be a mortgage, a car loan, student loan, longer than a year. Yeah. And of course, equity is what the owners own. Simply put. Now, you learned a lot today, especially about the accounting cycle and the processes involved. And we also learned about how the balance sheet is broken out by current and long term for assets, current and long term for equity. I'm sorry, current and long term for assets, current and long term for liabilities, and then of course we have equity. With that kind of information, we can run some very quick computations to understand the company's financial health, the financial well-being of the company. Now there's a couple of quick ratios that we can run. One of those is called the current ratio. The current ratio tells me about the company's ability to pay its current debt. Okay? The company needs to be able to pay its current bills. If it cannot, the company's in trouble. Okay? So what we do is we take total current assets divided by total current liabilities. Both of these amounts come from the balance sheet, of course. Current assets divided by current liabilities. If it's less than 1, okay, if it's less than 1, we in trouble. Okay, if it's less than 1, we in trouble. Costco in trouble. Costco not in trouble. They're around 1. They're close. They're okay. They can always figure out how to get more cash. You know, they'll not be in trouble. But less than 1, not so great. So we want a current ratio greater than 1, ideally, to make sure our company is safe. Sometimes we make errors in accounting. It happens, you know, people aren't perfect. We make mistakes. And when we make mistakes, sometimes we have to create what's called a reversing entering. We got to fix it. We make mistakes, so sometimes we've got to create what's called a reversing entering. All it simply means is that we are flipping the entry that we made in order to reverse it out. Yep. And sometimes this happens with payroll accruals, or it'll happen anytime that we make a mistake. And this is just an example of that reversing entry. As you can see, with the reversing entry, all we did is we flipped it, yeah? The original entry where we made the mistake was debit salary expense, credit salaries payable. Whoops, I meant to do that in January. So I need to fix that. So I debit salaries payable, credit salaries expense to reverse it out. That's what I call it, reversing entries. And again, this usually happens when there's a problem made with the accrual entry or if there's a accidental entry that we made. You can't just delete it from the system. That's not good. That'll get you in trouble. So never delete a transaction. That's really not good. Don't void a transaction. Don't delete it. All you need to do is make a reversing entry. Okay. The reason why, if you delete a transaction, you get a lot of trouble for that. You'll get audited for sure. Okay. So definitely don't delete stuff. If you make an error, identify the error and make a reversing entry for it. I cannot express that enough. I've seen a lot of people get in trouble with that kind of stuff. Okay. We made it to the end. Oh my goodness gracious. We made it. We did it. Accomplished. Okay. Uh, any comments, questions, or concerns so far?
Definitely a lot of information, and then I will have to look at the recording. But so far so good.
Cool. Thank you, Nick. I appreciate you saying that. Yeah, it's a lot. You know, we do 2 chapters a week, so it's a lot of stuff that we're throwing at you. Okay. So along those lines, I want to bring you back to the classroom, show you what's happening. Okay. We're currently in Module 1, so Blackboard Module 1. We're in week 2. I know, second week already. Can you believe it? What you owe me by Sunday, the Chapter 3 quiz and the Chapter 4 discussion. Chapter 3 quiz, you got 2 attempts. It's a mix of true, false, multiple choice, about 5 questions. Very straightforward. Chapter 4 discussion, it's a discussion board. Okay, I'm asking you some questions. I would like you to please respond using full paragraphs. Okay, full paragraphs. Don't not just a few words. That's not going to cut it. Okay, full paragraphs, please. And I want you to respond to 2 or more of your classmates. This all needs to be done by Sunday night, please. Don't be late with that, especially because it's hard to give you credit for a discussion board if it's late because the discussion already happened. Yeah. So please, my recommendation, of course, is to use the class time that we would normally have on a Thursday to complete that kind of work. Yeah. It's always best to work ahead whenever you can. That's just tips for success. And then also, if you need more help understanding this stuff, I really do recommend that you use this practice exercises by topic. Like if you're like, man, I kind of get the accounting equation, I kind of don't, give this a try. Yeah, just download it and try it out. I promise it helps to reinforce the concepts. But these practice exercises really put it together for you. Because one thing I learned about accounting for teaching it for many years and also doing it for many years is that you learn a lot more by practicing. And it really is a practice. So I recommend you do that as well. And if you still really need a lot of help, Professor Remy is a tutor for accounting. And you can also hang out with me. You can schedule some office hours if you need some additional help. And of course, you always have my email address, my phone number, so you could always email me, call me, set up office hours, whatever you need. I'm here for you all the time. Promise you. Is there anything else that I can help you with today before we call it a day? Y'all good? Okay. So I want to say thank you so much for your time today. I appreciate all of you. Anytime you need anything, feel free to reach out. I'm here for you. Please make sure that you complete the Chapter 3 quiz and the Chapter 4 discussion board by Sunday night. Thank you all so much. I appreciate you. Have a wonderful rest of your day. Thank you so much. Bye.